So one does have an insurance policy, we're gonna uh, share with them, um, share with them whole life versus term. So there's a couple questions you do ask if you do discover after you do the statistics. You guys remember the statistics from Saturday? And you ask them if they do have a policy. And then after that, rather than you going to create a need. By the way, if someone has a policy already, you don't need to create that much need because they already have a policy. They understand the value of insurance. They're not going to be like, what does life insurance mean to you? They ain't gonna accept. God forbid something happens to you. What kind of lifestyle do you want your family to have, right? You don't got to go through that because they already have our insurance. They already see the value of life insurance. So what you could do now, you can kind of like go into the difference between whole life versus term once you discover that they do have a policy. But before you actually start going into it, you want to ask them a couple questions that could actually help you kind of like figure out what type of policy they do have. So let me ask you a question, Edison. What company do you have insurance with? Okay, and the roughly what you think you're paying for it? 124. Okay, do you know if it's the one you can borrow money from?
Yeah.
Have you borrowed money from it?
No.
No. Okay. All right, no problem. And how long ago you took it out?
3 years ago.
3 years ago. And the person that did it for you is somebody you know, or is it like from work, or how did you do it?
Yeah. Something.
Friend of yours. Okay. You guys are still in contact?
Yeah.
Okay. All right, and that's good to know because if you're still in contact with his friend and it's the friend, we kind of like, we're gonna thread a little light fence there because sometimes he might believe in his friend more than me that he just met. So I want to keep that in mind for now. Okay. So those are just light questions that I'm gonna ask you, and then we're gonna go into the different types of life insurance. So Edison, I'm just gonna share with you briefly. There's two type of life insurance. This is just general knowledge, and this is just good information for you to know. There's cash value, and then they do have term. Now, cash value, so they have different names. So
Which one is that? You on the tablet? You on iPad?
Yeah.
Screen or keyboard?
better. Can I get rid of this?
Yes.
So there's two type of policy. There's cash value. Cash value, they call them whole life, universal life, adjustable life, take my life. They don't take my life, that's just a joke. How this works, you pay for the insurance and you have like a savings. So let's just say, Edison, you have 100,000 insurance. After 20 years later, the cash value goes to 35,000. So now you got 100 plus what? 35. So now if God forbid you die, right? Your family gonna get 100 what? 35,000. But guess what? That's not the case. What will happen is the company will keep the cash value and your family won't get the 100,000. Do you think it's fair for them to keep their money? Of course not, right? But what they will do that because that's how the policy works. If you actually live until age 100, because that's usually how long the policy goes until, the company will give you the cash value, but you no longer have the insurance. So in actual, to get either or, you cannot actually get both. So what we do say here, if you do need the money in the cash value, you're gonna have to borrow, and you're gonna have to pay back an interest. Now, who money are you borrowing?
My own money.
Your own money. So you have to borrow your own money, and then you gotta pay back an interest. And for the first 1, 2, and 3 years, usually no money goes in the cash value. So if you put away $100 a month times 12, you put away $12 a year, $12 a year, $12 a year. In 3 years, you put away $3,600, and you're gonna be lucky to get $100 in the cash value. So you put in 3,600, you only got 100. If you still need this 100, you still gotta borrow, and you still gotta pay back the interest. This type of life insurance is usually 4 times more expensive. And the reason why it's so expensive because this is how it works. What I do recommend you do, Edison, I recommend you buy term and invest the difference. Now, term insurance is usually less expensive, but it's just insurance. You pay, you cover it, you die, your family get money. But then there's different type of term. There's 1 year term, meaning the policy increase every year. There's 5 year term, meaning the policy is going to increase every 5 years and 10 years. So what I do recommend if you're going to get term, you're going to get long term. You're going to get term for the max amount of years you could possibly get. If you get like a 30-year, that'd be great. For the same 100,000, if you're paying $100 a month over here, if you get it for $40 a month, so now you're gonna spend less. 40 from 100, you're left with what? 60. You take the $60, you can put it like in an IRA or some type of investment. So now this money grows to 35,000 over the years, and now you die, your family get this 35,000. Your family also get this 100,000. And if you need this money, you can take it out cash. You don't have to borrow. You don't have to pay back interest. This is going to be your money. Now, it is option A, option B, which makes more sense to you. Option B, right? So one thing that we could do, Edison, we could probably find out and see which one you do have. Now, obviously, if you already got A, if you already got B, I should say you already set up. But then if you got B, if you got B, you already set up. But if you got A, then I could probably, double check and I could, give you my best recommendation. Okay, sounds good. You want to see if you could grab the paperwork real quick so we can see which one is it?
Yeah, sure.
Sure. Okay, good. And then you wait for it, right? Now there's a situation where Edison is gonna give you, he's gonna hem and haw. You're gonna get hem and haw from Sarah?
Yeah.
So let's just say Edison start hem and hawing. What are some objections that he actually might have at this moment, and some ways that we could actually overcome some of these objections?
I don't know where it's at.
I don't know where it is. Okay. And when someone said they don't know where it is, it's not for you to be like, okay. And just keep in mind, whatever objection the person's going to give you, it's just a way to kind of like blow you off first. When you're closed, you don't get thrown off with the first objection. That's not what we do here. So, and actually, that's actually the first one. So if someone says, I don't know where the policy is, he said, that's fine. Just look to see if you can find it. These are important documents. I'm sure you know where it is, and also I can help you look for it. So most people know where the important document is. The policy could be it's somewhere. Okay, they might just not want to go right now to look for it. Okay, but you want to remind them that these are important documents, right? I'm sure you kind of like you have an idea where it is. If not, if you need some help, I can help you, look through some stuff and maybe we can find it together. Okay. Every once in a while, the client goes, the policy is in a safe at the bank. That's fine. Do you have a copy? Okay, so they will keep the original in a safe or somewhere, but they might actually have a copy. Or do you have a statement, or did the company send you anything in the mail? Okay, so maybe they don't have the actual policy, the original policy, but they might have a copy, or maybe if the company actually sent them something in the mail, or they have some type of statement or something. Every once in a while, you do get this one. I got to speak to my agent, right? If they do say that, that's fine. You can speak with the agent, but we are trying to do is to see what you have and give you my best recommendation to see what we can do. So if they do express that they need to speak to the agent, which you are saying, okay, that's fine. You can always speak to the agent, but the first step we'll be trying to do is just trying to see what it is that you have, and I'll give you my best recommendation. As a matter of fact, we're just trying to see. We don't know what we're doing. Sometimes people might come across, I'm not changing my policy, I'm keeping it, well, listen, hey, we're not making any changes, we're just trying to see what it is so we can give you our best recommendation and what we think you should do. Make sense? So, you always goes off that route because we don't know if we could help. Sometimes I've had, not a lot, but I've had a situation before, I'm like, all right, there's nothing we can do here, okay? But, so then there's a situation where obviously we can help. Okay. If someone goes, I'm fine and with what I have, and I don't want to make any changes. Okay. If someone is fine with what they have and they don't want to make any changes, a high possibility they're probably just going to understand what you just went over. So what I like to do is I like to go over it again. You might say, well, I got to go over it again. Yep, you should go over it again until they get it. I think Cynthia, you texted me about a client, right? And she was trying to close, and there was a situation with the company closing, and I'm pouring out my heart, trying to give her, a couple of stuff, through texting, and then she goes, well, she's a little distracted.
The client?
If the client is distracted with the kids, what's the chance of you closing?
No,
It's very, very, it's hard. Okay? I'll probably give the kids my phone, my iPad.
Give them my little books we can draw.
Some-
hopping in and out.
Yeah.
They're supposed to sleep.
Yeah, it's hard. It's hard. They're distracted. They got to deal with the kids. So if you're on an appointment and that's happening, for one thing, you got to figure out how to get rid of these kids, because they're gonna mess up your clothes, or figure out if there's an adult or somebody in the house can keep them for a little bit or something. Because I ain't fixing to do all this work, and next thing you know, the client ain't get it, and then they're not going forward because they just don't get it. So there's distraction that could be in the house where you're explaining and you're pouring out whole life versus term, and you've given it all you got, and it just then they didn't even hear what you just said. So you got to pay attention to that. So I like to go over it again, and I might say something like this. Well, I understand that maybe you don't understand 100%. Let me go over it one more time again. But I really need your undivided attention. I really need to focus on what I'm saying, okay? Because I want you to see. I want you to get it. The thing about seeing and getting, when people get it, it's like a light bulb went off. They get it. So if the light bulb is not going off, then I possibly they're not getting it. I'm gonna call you. Thanks for the information. Every once in a while, you might explain whole life versus term. I'm gonna call you. Thanks for the information. Okay. By the way, if someone tell you thanks for the information, you're not closing with a check. That's not good. Okay. We're not here to do a presentation, and we're not nonprofit. We gotta make money. So don't thank me so much for this information, how wonderful it is, and you learn so much. So oh man, I learned so much. Thank you for coming, and I'm leaving without a check. Okay. If it's that good, then you should be willing to go. You should want to go forward. Okay. Thank you for the information. If someone says that, there's a high possibility they don't understand what you just went over again. And I'll probably go over whole life of CERN one more time. Or you can say, did you understand everything I just explained to you? They'll say yes, no, and then you can say, well, yes, I do. Okay, well, are you sure? Okay. All we can try to see is we can figure out what you have. Let's try to figure what you have and see if it's if it makes sense for us to go forward. Is that fair? My mom has a copy of my policy. I don't keep it here. Every once in a while, you do run into people that, maybe the parent have a policy on them, and the parents have the policy. That's fine, but do you have a statement? Do you have a letter? Do you have an online login? You can actually go online now with the way things are. A lot of these companies, they have access to their online. If they actually don't have an online, you could actually help them create an online. Okay, once in a while they might ask for the policy number to create an online. I think Primerica doesn't even ask for the policy number. Someone could actually go online and just put the information in, and then we could view all the policies and everything like that. So I'm assuming maybe there's other companies that you actually probably don't even need to have the policy number in order for you to actually create online. So keep that in mind. If it's during the day, normal hours of business, like a 9 to 5 business, Monday to Friday type of deal, the easiest other ways to do is call the company, and you can find out exactly what you need. Someone says, I have this insurance for a long time. I don't want to lose any money. By the way, this is upfront before you actually see the policy. So you want to be as light as possible. Okay. You don't want to it's not time to go in yet. Okay. We're going to go in later. Okay. So you just explain whole life versus term, and the client goes, well, I don't want to, have this policy for a long time. I don't want to change. I don't want to lose any money. Well, that's fine. Here's what we're doing. We just want to see what it is, so I can give you my recommendation of what I tell you, what I think you should do. Let me ask a question. If we find out, because based on the years and how long they have a policy, we can just throw some numbers out there. Let's just say we find out. Let's say you go, oh man, I have my policy for 30 years. Let's just say we find out you have $10,000 in cash value, right? Would you rather you getting that money, or you rather the company gets it? You rather get it, right? Because listen, if I leave it today, and God forbid something happens to you and you pass, right? The insurance company going to keep that $10,000. Now, if you can get it, would you rather get it? And on top of that, if you call them and tell them you need it, you're going to have to borrow, and you're going to have to pay them extra interest in the credit loan. So with me, I can help you get it. It's not going to be a loan, and you don't have to pay back. How you do that? Well, if you find the policy, I can show you how I can do that. See if you can find the paperwork for me, and I can tell you, give you my best recommendation. I'll tell you what I think you should do. So it's very light. We're going to get to the close. Because I'm not closing if I can't see what you have. Like, it's hard for me to close if I can't see what you have. I like to really do a full comparison. Every once in a while, someone says my agent is good to me, that's fine. We just have to, just want to see what you have so we could, see what's best, and I give you my best recommendation. I don't want to switch, that's fine. We just need to have, just want to see what you have, so I'll give you my best recommendation. I thought it was. I don't have the policy where, I don't know where the policy is, right? We went over that earlier. You can get it on the app. Are you sure I'm gonna get my cash value back? I'm gonna help. I'm going to help, and I'm gonna help you read the policy, and whatever you have, they give it back to you. Or you can say, well, I will help you find out and see what it is in the cash value. If there is money in the cash value, there will. But usually sometimes they give you a percentage, but let's just find it first and see what it is so I can see what, what's what. Okay. Does your policy have cash value? Have you ever get that before? Well, does your policy have cash value? No, we don't, but we have something called an investment. We'll help you set that up, and the investment, if you need the money, you can take it out, you don't have to borrow, you don't have to pay back purchase. Remember the example I showed you earlier? Every once in a while, someone throw out all the top of their head, they goes, what happened after 30 years hence? Well, you pay the same premium, but less coverage. And then there's no proof of insurability, but also keep in mind that we spoke about investments. So if you do outlive your policy, you'll have a certain amount of money saved actually in the investment as well. Very light, unless it's, you go, well, how does that work? Then you can go more in details, but very, very light there. Now, when you do view the policy, there's things that you look at on the policy that can help you make a decision. Okay? Or for things you should be looking for when you actually view the policy. So, obviously you'll need to know the name of the company. So you can at least have an idea. Every once in a while, someone says they have New York Life, and you find it's Transamerica. You're like, the type of insurance, you want to verify the type of insurance, whether it's whole life or whether it's term. Verify the coverage amount, like how much coverage they actually have. How much is in the cash value? How much is monthly payment? When was the policy open? It's the issue date when the client took out a policy. You actually need that when you're doing the application. And if there's a loan or any outstanding balance loan, you want to find it out as well. And then whatever the interest rate, you want to point that out with the client as well. So based on this information, you'll be good enough to do a comparison, for the client actually. So here we are, we're actually looking at an actual policy. So what an actual policy is, this is an actual real example of a policy. This is a whole life policy, right? Well, first of all, you guys know, what are we looking for? What is the thing we're looking for?
Cash value page,
Cash value.
the front page of coverage, and how much they actually pay.
Actually, type of insurance. Name of the company, right? And where is usually the name of the company?
Page.
First page.
Most of the information they read.
Okay, you can't go wrong. It's on the first page. Don't say bring the paperwork to you. You're like, oh, Transamerica, New York Life, right up top. Okay, so you ain't gonna be like, oh, I can't find the name, man. I don't know what the name is. Okay, it's gonna be on the first page. It's really like dummy proof. Okay, so Transamerica, right? We see the name already, so we know it's Transamerica. If you go down here, right, we see that the policies are what? What type of policy it is?
Whole life.
It's a whole life policy. If it's a whole life policy, you remember the example where I did the whole life versus term, those examples, right? We know that it's going to work as just like how it is an option A. But also it goes in more in detail. It says it's a fixed premium, durable, fixed premium payable during the life of the insured maturity date. Life insurance proceed payable at death insured prior to the maturity date, and a bunch of other stuff here. That's just going over the type policy. Okay, so usually around the third page, you probably get the coverage amount, okay? You're looking for something that looks like this, okay? The coverage amount is how much?
50,000.
50,000. What's issue age? 35, so the person got it when they were 35 years old. And what's the monthly premium?
131.
131 monthly, right? So the effective date was January 1, 2009, so the client took the policy in 2009. So the client still had this policy in 2000, from 2009 to 2026. How many years is that?
17 years.
17 years, right? So the client has this policy for 17 years. Then when we do go to the cash value page and the client still has this policy, we go 17 years, cash value, this would be the approximate amount of money we think they're probably having the cash value. You guys get what I'm saying? What else we could point out here? We could point out the current interest rate is 4%. The current loan interest rate is 8%.
That means what they gotta pay back.
Yeah,
Gotta pay back 8%.
yeah, they only getting 4%.
That's a lot.
So this is the cash value page, right? Remember we was talking about the cash value page?
Yeah.
So the first 1 and 2 years, right? How much money is in the cash value?
0.
0. You guys can see it, 0, right up here. So now we're assuming that the client had the policy for 17 years, and it doesn't adds up because the client's paying 131 times 12. 131 times 12. Somebody has a calculator? Who has a calculator? What is the 12 for?
The month
For the months, for the year,
for the year.
and it's 131 they're paying monthly.
That's 1,500.
1572. So the client put in $1,500
$1,500 for the year.
a year, right? So that's all right. It's $1,500 a year. So in 2 years, 15 and 1572 plus 1572 how much?
It's about 3,000 and change.
How much?
3144.
3144. So the client put in $3,144, and they still have 0 in the cash value. Crazy, right? And then after 3 years later, I'm assuming they probably put in about what 45, 40,
3 years later?
Yeah,
47,
47,
47, 60, right?
16.
16. So the client now put in 4,716. And how much they have in the cash value after 3 years? 294. And if they needed 294, they still got a bar, still got the regular interest. Now let's just assume that this client has a policy for 17 years. 1572 times 17, how much is that?
26,000.
26,000. So the client put in 26,000 into this policy, and the cash value is how much?
9,000.
17 years, $9,171. So they put in 27,000,
That's crazy.
and they only got $9,171. Now think about if the client had put away. Kim, you're gonna do an example later, right?
Yeah.
If the client had take that initial investment and they put it into an investment for 17 years, you'll see the difference how much they're gonna have in 17 years. And if they need that money, they can take it out and they don't have to borrow. They don't have to pay back the interest. You guys get what I'm saying, right? So that's kind of like, I mean, if you do that, then pretty much you're done here. All you got to do now is just do a comparison, show them what they have, right? Just break it down now, and then do option A, option B, option C, and there's a high possibility, like 99.9% of chances, we're going to be able to beat this coverage because the client is only 35. They're paying $131 a month.
Right.
I mean, off the top of that, we could probably give them a certain amount of coverage a year. That's going to be a lot better. So these are all just jumble. Then here you got to drive yourself nuts about. Reading the policy is very simple. Once you get what you need, pretty much everything is pretty much done. So what is an example of if you do let me see something.
I got a question.
Sure.
Where do you show them in the policy where it says that the money go back to the company, the cash value?
It's gonna be like these fine details.
Yeah, you're gonna have to read the fine print for that.
Not gonna
You
have that.
showed me like one time, but I don't remember.
Yeah, you don't need to show that.
Okay.
The easiest way to prove that is I would tell them that that's the reason why you have to borrow, because if you didn't have to borrow, you would be able to use it. So clearly, if you're borrowing, it means you don't own it. You don't borrow. Yeah, that's the easiest way to.
So now that you're running the quote, you do current, whatever the client has,
Right.
and A, B, and C. I'll get this up.
Oh, wow. That's the first I heard you say that.
What you say you gonna do it either?
Yeah, he said he don't like how we
Never.
Right. Like, look at the numbers, the numbers is important.
So the current, what they have, and there's actually an actual sheet for this.
Mhm.
So the client has 50,000, they're paying 131, right? They have a policy now for 17 years. So they got 9,171, I think, in cash value.
Right.
And they're paying $131 a month
For 50,000.
for 50,000. So the client is 17 years older, right? So they was 35. How old are they now? Doug is not here.
Oh, sure.
Doug has left.
52.
How much?
52.
52. So here you are, you're sitting down with this client that's after 17 years later. And now we are going to try to close them on why it makes sense for them to still do business with us. Now, granted, if you had sat down with this client at age 35, then you'll find out that the premium for age 35 would have been a lot less, right?
Yeah.
Who has
Oh, the app.
you have the app on your phone, Cecil?
Here you go.
No? Okay, so we're gonna work on that. I mean, you do have the framework, right?
Yes, yes, you
You
do.
have to study, right?
Yes, you do. I have to log in.
You have the app on your phone, so you have to study.
You got the app.
So the same app that you have on your phone is gonna be the same app you're gonna need in order to run a quote,
Yeah.
right? That's why you keep the app, you keep the service,
You
because
do that.
it's the same app you're gonna need in order for you to run and operate your business. Okay? So at age 35, how much is 50,000 in coverage? Yeah.
Can be like 20.
Oh, we're just gonna guess it.
I'm gonna do it.
Can be 36.
Yeah. I'm doing
Can be 36.
it. At 35, we're doing 35?
Yep.
I got you. It's a male or female?
Let's make it a female.
Okay. It is $73. Wait, no, sorry. I gotta try right up. Sorry. Oh, it's $19.
19 now. So if we had done this policy 50,000, when the client was
Yeah, it's over.
the person smoked, that's a smoker rate?
Yeah.
That's a smoke, okay, let me put the smoke rate, hold on.
No, non-smoker. That's a smoker rate?
No, that was.
Right,
I'm
No, it says tobacco on the policy.
Oh,
So
my policy said tobacco?
Yeah,
Nah, I ain't
the-
got tobacco. They don't smoke no more.
Well,
So 50,000 is
This
what,
is, the
$19?
non-smoker is $19.
$19. So this,
$19.
we still smoke with still $48.
so Mr. and Mrs. Client, oh, yeah, it'd be cheaper anyway. So Mr. and Mrs. Client, 50,000 with us, 19, when we're younger. So you don't want to pay $19. That goes to show you how much more expensive this
my
policy
God.
is. But if now the client is 17 years later, so the client is how old now?
52.
52. And how much is 50,000 to 52?
It is. That's what they want,
Precision term.
25 years.
Precision term. That's where you're about to lose your life at. Talking about the amount of years you're gonna get.
No, I'm telling you that, alright, anyway. It says
50,000 for 52
It
year
says
old.
$62.
Okay, female,
Yeah.
class 4, precision term. Not power term.
Precision term, oh. okay.
Yeah, I'm about to tell you that.
Why are we doing precision term?
50,000.
I'm gonna give the client the best rate possible.
Okay,
One
so
or two.
that's 51.
Precision is the best rate versus a power term. I mean, I know some of you guys,
We gotta do medical, right?
some of you guys
55.
would rather do the power term because you might not gonna do enough of a good job of following up and making sure they do medical, but I'm assuming they're gonna do the medical. Okay? All my clients assume they're gonna go through, they're gonna do what they need to do, okay? So is it $50, $52?
But it's 55
55
84 with
84.
the waiver agreement.
And everybody get wages of greater premium.
Right.
What's the difference between 55 minus 131? $76. By the way, you're doing this at the kitchen table, so
Okay.
you know I want you to get in the habit of knowing how to do this. Okay. So and then what is 150 precision term?
150 is
No, that was precision.
yeah, but that was 50. 150 is $107.
107.
Mhm.
Okay, so do 75,
Okay.
That's 97.
97,
That's 81.
97, and then
Oh, yeah, more
150 is 107.
Yeah. It's 81 for
It's
for
81
75.
for precision term.
Yeah.
Yeah, if I'm like comparing price, I'm gonna do precision because precision is gonna give me the better price.
Okay.
What's the difference between 81 minus 131?
50, right?
50. And then 107 minus 131?
24.
$24.
$4, okay. So, Mr. and Mrs. Klein, this is what I came up with. I mean, right now you have 50,000 coverage, you're paying $131 a month. You got $9,171 in your cash value. If you die, God forbid something happens, it comes in, keep that money. If you call the insurance company and say you need this money, you're gonna have to borrow, and you're gonna have to pay them back with interest on your own money that you actually put in. So there's a possibility to help you get this money. You don't have to pay back. They will send you a check for $9,171. So, but here's what you have to do. You're the option, and this is what I could do for you. I still can give you the same 50,000. You're gonna pay, rather you pay 131, you're gonna pay $55 a month. And then so 55 a month, you're gonna save yourself $76. Or you could get 75,000 coverage. You're gonna pay $81 a month, so you're gonna save yourself $50. Or 150,000, you're gonna pay 107, so you're gonna save yourself $24. Option A, option B, option C. That is which one you think is best for you?
So,
0. Option C. Okay, so we recommend this one. You get an extra 150,000, right? So if you did, and then, okay, so let's get you set up. The only thing we're gonna need to do, we're gonna have to put an application in. And this is just to get approved. It's gonna take about 2 to 3 weeks. We're not gonna make any changes with your current policy. We're gonna keep what you have right now. And then until you get approved, then we'll make the transition into the other policy. Then I'll come back and help you get the check for $9,000. Sounds good?
Yeah.
And with this plan, it's gonna require you to do a physical, so they're gonna call you, set up an appointment to do a physical, let them know the day and the time when it's best for them to come. The sooner you do this, the better. Okay? Now, what you can do here, just to further your case, and I know Kim is gonna show an example in a second, but since we're on this one, you go to the financial calculator, right? And you put in 9,171 in the beginning balance. And then you put in the monthly amount, which is the difference is what? $24, right? Would be the monthly amount. And then that will give you the amount they're gonna have. This policy was about 25 years, so there's for 25 years. And how much that adds up to?
What was it? 9,113?
$9,171. How much you came up with that?
How much is a month? $24.
$24 a month. Doug is giving you guys a chance.
Giving us a chance. It's 113. 113,000.
113,000.
393 to be exact.
So that simply means this client gonna have 113,000 in 25 years. So this client, we're gonna take the difference that you actually have, that money that you get back when you spend it, we're gonna take it, we're gonna invest it, and then along with $24. Now, what if you could put a little bit more than $24. Let's see if you could put 100. Bump it up to 100 and see how much work it is.
$199,000.
Make call it 200,000. So Mr. Client, next 25 years, got 20,000 saved. Would that be pretty good?
Yes.
Oh yeah. Right. That 200,000 is 200,000. You don't have to borrow. You don't have to make interest. That's gonna be your money. So, if you're sitting down with someone that has another policy from another company or like their stuff, it should be an easy close. Now, there is other situation where someone goes, I do have a term policy. Not all term policies created equal. This is not a term, this is a group. Not all term policies created equal. So if someone has a term policy, it's good to kind of like, yeah, that's pretty fine. Let me try to pull it out at 30%. Not all term policies created equal. Or you could you see that little portable charger in the back next to you, Doug? Just grab the whole system back there. So not all things are created equal. So if a client has a policy with a group policy, not a group policy, client has a term policy, we actually want to find and see how long is the term, how long they have it for, and we also want to verify the renewable rate when it's going to renew. Like if a client has a 10-year term and they already got 5 years in, right? They only got 5 years left. So Mr. a client, even if they're paying less for it, I said, Mr. Client, this policy is going to hit 5 years, going to jump from you pay $22 a month. It's going to jump for you to pay like $150 a month. So even though I can't give you this rate, but if we could offer you something that's longer, we like to do it. Okay, so you kind of like you could focus on that and just to see what it is. And every once in a while you do have someone that has a term policy where the amount they're paying might be less than ours. Okay, but I think sometimes like how long is a term is important. But most people don't have a 30-year term. I've never seen a 30-year term. I think I've seen it once in my entire life, and it was a no-name company that actually had it. So most companies don't even do 30-year terms. So you're sitting out with a client that have a 5-year, that have a 10-year. You could easily beat those and show them why it makes sense for them to actually do business with you. Any questions on term products? Good. Every once in a while, a client goes, go ahead. So,
you said most companies. What do most companies do for term?
So they might have like a 1-year term, or they might have a 5-year term. So the amount of years is short, and then we don't do 1 year. We don't do 5 year. So we're going to give them like a 30-year. So it's going to stay level for 30 years, which is longer.
30 years?
Yeah. Yeah. So it will be for longer versus short. Because if it's short, that means it's going to boom. It's going to increase, and the client's going to pay a lot more. The shorter it is, the longer it is, the longer it takes for it to change. Go ahead, Tania.
Oh, I just want to know, when you get the cash value back, you tell them to put it, you tell them to put it in like that?
I usually recommend them put it into the investment.
Okay.
Doug? Michael?
Yeah, so how do you have both the term and the whole life in one policy?
Sometimes they do that.
Yeah, so how do you go about that one?
I just replace it just the same. I don't really focus on the term as much. I focus on the whole life in that case. Because you're gonna find that if that's the case, then chances are that they might do like a short term just to boost up the coverage. So they might do like a 5-year term or something, or like a 10-year to make it look like the client has a lot of coverage. But then when you run the math and you do the numbers, even with their little 10-year term, the whole life is so expensive that the whole life just trump everything. We could throw in a 30-year term in there, and you're gonna find out that our plan still beats everything that they just did. They never could win. So every once in a while, you do see a client that goes, I have insurance through my job. Okay, this is kind of like how you deal with that. So there's a couple things here you could just hammer. Okay, usually you're limited to 1 to 3 times your salary. experts, say that you should have, so if a client is making, let's say, $50,000 a year, or $40,000 a year, $20,000 a year, whatever the annual salary is, it's 1 to 2 times that amount. So if you have making $50,000 a year, let's just say your coverage might be about 100,000, maybe about 150,000 that they might have at the job. Lucky. And then some people are sitting down with, they're making what, $30,000 a year. So 30 times 3, what is that? 90,000.
Yeah.
If you're lucky, they might have that. You know, I've seen it where they only got 30,000. So, but you could also express recommend you have 8 to 10 times the amount of 8 to 10 times your income. So we recommend you have at least 8 to 10 times the income. So if you're making $100,000 a year, if it's 8 times, you need at least 800,000 to at least a million. You're only covered while you're employed. So if there's a sickness or disability or something happens, usually you're no longer covered. So you also got to keep that in mind. Because just think about it. Remember, the premium is coming out of your paycheck. So if you're not getting your paycheck anymore, then chances are the spouse is not getting paid. You have to requalify for your coverage if your group coverage ends and your employee change company. There's a lot of situations. I can send it to you guys. Don't worry. You don't have to. So if in a lot of situations, a lot of companies tend to change companies. So if you're working for the company, the manager, the owner goes, "Oh, we're gonna change insurance companies for whatever reason, right?" If they change insurance company, now you're gonna have to qualify for that coverage now because it's a different insurance company. So you also want to keep that in mind. What else is there? So you have to requalify coverage, your group coverage ends or your employee changes your company. Age and health could be a challenge. Wouldn't you like to be in control of your own coverage so that you never lose your coverage, right? So now you're older, health change, and now they decide they want to go to another insurance company. Some group policies only cover you at work for a specific situation, accidental death or terminal illness.
Yeah.
Do you know how and where you're going to die? Do you know how and where you're gonna die? Wouldn't you prefer to be covered no matter what happens? Right? I mean, that makes sense, right? One size doesn't fit all. They do have like a one size type of fit all type of stuff where you can't really customize the coverage. If you're an employee A, employee B, you all get pretty much the same plan. Only insures employee. So in certain situations where you're married and you have a spouse and you have a child, kids, usually kids are not covered on the policy. If something happens to your spouse or kids, shouldn't they be covered as well? Your cost and insurance at a moment based on the contract between the employer and the insurance company. Shouldn't you prefer your premium to be locked in for the predetermined amount of time, regardless of what happens to your company's insurance companies? And the good thing is you get when they have a policy, they have an 800 number for our HR department. Right, they have nobody they could really talk to, ask questions, and you are actually that person where they could communicate with and talk to. You could talk to them on the weekend. You could talk to them on holiday. They're gonna have your cell phone number. And it comes as a service for them to even do business with you. You're gonna get somebody that can actually talk to, which is unbelievable. Go ahead, Benson.
No.
No question. Okay, good. All right, so I hope that helps. If you could, I'm gonna have Kim